Oke, perkenalkan saya Aisyah Riany Oemar dengan NIM J0414241145 dari akuntansi B2 di mata kuliah Manajemen Keuangan dengan dosen pengampu Pariki. Di sini saya akan menjelaskan case 1 dan case 2. Di mana di case 1 dikasih tahu bahwa Aurora Biotech Limited, a mid-sized pharmaceutical research company based in New York City, is planning to expand its production facility to accelerate the development of a new antiviral drug. Now, to finance the expansion, the company is considering issuing a new series of preferred stock called Series P preferred shares. Now, each preferred share is expected to offer an annual dividend of $6 paid quarterly and will be issued at a par value of $100 per share. Now, the firm's investment banker from Stella Capital Partners estimate the market yield required by investors for securities with a similar risk is around 7.5%. Now, the management team is analyzing whether issuing preferred stock will be more beneficial than taking on additional long-term debt, given that the company's existing debt ratio is already approaching its internal limit. At the same time, several existing shareholders have raised concern about potential dilution of voting power, even though preferred shares do not carry voting rights because the issuance might signal weaker financial flexibility. As a part of their capital and evaluate whether this financing strategy aligns with the company's long-term capital structure objectives. Now, the first question for this case is, based on the dividend and required rate of return, what is the estimated fair value of or Series P preferred shares? Okay, so to determine the fair value of the Series P preferred shares, we use the dividend discount model of perpetuity, where, as you can see over here, the annual dividend is $6 and the required rate of return is 7.5%. Now, the formula for this is you divide the annual dividend, that is $6, by the required rate of return, that is 7.5%. And if you turn that into, and if you calculate that, it will, the estimated fair value is $80 per share. And that is number one. And then number two, how does the cost of issuing preferred stock compare to issuing additional debt? And why might the management prefer one option over the other? Okay, so first we have to compare the cost of these two, where preferred stock is generally more expensive than debt because dividends are not tax deductible, whereas interest payments on debt often are. And now the CFO, who is Alina Marquez, may prefer preferred stock because the company's existing debt ratio is already nearing its internal limit, as stated on the case. Now, the financials for the financial flexibility itself, issuing preferred stock allows the company to raise capital without the legal obligation of mandatory interest payments that could trigger default if missed. Okay, and then for the next question, what potential concerns might common shareholders have regarding the issuance of new preferred stock, even though preferred stockholders have no voting rights? Okay, so shareholders might fear that the issuing preferred stock might signal that the company has reached its limits for a cheaper debt. So that would indicate that the company has weaker financial flexibility. Now, the preferred shares have a prior claim on earnings over common shares, meaning preferring dividends must be paid before common shareholders receive anything at all. And although there are no voting rights, the fixed dividend obligation increases the company's financial commitments. And as for the last question, how could issuing preferred stock affect Aurora Biotech's long-term capital structure and financial risk profile? Okay, so using preferred stock adds a layer of equity-like financing that does not dilute voting power, helping the company stay within its debt limits so that it doesn't go over the debt criteria, and it will stay, the shareholders will actually see that the company has an adequate financial flexibility. And also, it lowers the risk of bankruptcy compared to debt, but it also increases the overall cost of capital and adds a permanent fixed payment obligation to the balance sheet. And that is for the first case. Now, for case 2, we have Ardenix Manufacturing Group. Okay, so Ardenix Manufacturing Group, that is a mid-sized industrial equipment producer, is planning a major expansion of its automated production line. Now, to finance the project, the company intends to use a 10-year corporate bond with a face value of $1,000, an annual coupon rate of 7%, and semi-annual interest payments. Now, the managed team led by that believes that issuing bonds is more attractive than obtaining bank financing issues because interest rates, the credit market have. However, some board members are concerned about rising inflation forecasts, which could increase market interest rates and reduce the attractiveness of the bond investors. Meanwhile, a credit rating agency, Prime Rate Assessments, is evaluating Ardenix's financial performance to determine the bond rating. A lower than expected rating could force the company to offer a higher coupon rate or issue the bonds at a discount. Investors, including the portfolio manager from Sterval Capital, are examining whether the bonds fit into their long-term fixed income strategy. Darius is particularly focused on the bond's yield to maturity, or the YTM, the company's leverage position after issuing the bonds, and the projected cash flows from the expansion project. Ardenix Management also anticipates that the expansion will increase production efficiency by 25% coupon payments. However, if the expansion underperforms, the company may face liquidity pressure and potential difficulties in servicing its debt. Okay, and the questions for case 2, the first one is, how could inflation expectations and potential increases in market interest rates affect investor demand for Ardenix 10-year bond? Okay, so there are about 2 impacts of the inflation and the interest rates, where rising inflation forecasts typically cause market interest rates to die and just plummet and die. And if market rates rise above the bond's 7% coupon rate, the bonds become less attractive to investors, even though it is stated that it is a 10-year bond. But it would still be less attractive to the investors, that will eventually cause its market value to drop. And the second question is, if primary assessment assigns a lower credit rating than expected, what financial implications could this have for Ardenix's bond issuance strategy? Okay, so a lower than expected rating from primary assessments would signal higher risk, of course. And this would force Ardenix to either offer a higher coupon rate to the entire investors, or they could also sell the bonds at a discount below the 1 grand face value to provide a competitive yield. And as for the third question, from the perspective of Stellar Vest Capital, what key factors should Darius Wynn analyze when evaluating whether the Ardenix bond aligns with their fixed income investment objectives? Okay, so for the third question, Darius Wynn of the Stellar Vest Capital is focusing on several key metrics that are yield to maturity, post-issuance leverage, and also the protected cash flows. Now, to determine the YTM, or the yield to maturity, is used to determine the total expected return over the 10-year life of the bond, where the post-issuance leverage is to assess how the new debt affects the company's total leverage position, and projected cash flows is to evaluate if the expansion's income can reliably cover the semi-annual interest payments. Okay, and to calculate the specific price of the Ardenex Manufacturing Group bond, we must account for this semi-annual payment structure. If market interest rates or the required yield rise due to the inflation concerns mentioned by the board, the bond price will drop below its par value. Where in the bond pricing assumptions, the face value is a grand and the annual coupon rate is 7%, and so we can know that the semi-annual coupon is calculated as a grand multiplied by the rate divided by 2, and that would be $35. So the total periods is regarding the 10-year bond is 10 years times 2 and equals 20 periods. So now let's assume the market yield or the R rises to 8%. That means 4% semi-annually due to inflation, right? So we use the bond pricing formula that is P equals, I don't know how to pronounce this, the sigma of C divided by 1 plus R P squared plus F divided by 1 plus R on N squared, where in this case it's basically P equals 35 multiply with 1 minus 1 plus 0.04 and then minus 20 squared divided by 0.04 and then added with a grand divided by 1 plus 0.0420. So if you just calculate all of that, the present value of the annuity for the coupons is about around $475.66, which would make the present value of par value $456.39. And then we would add both of them, and so the total bond price is $932.05. So the financial implications of this price is trading at a discount because the market requires an 8% return, but the bond only pays 7%. Now, the bond must sell for about $932.05, as we already stated before, which is a discount of $67.95 to remain competitive. And now this has its own impact on Ardenex, right? So if they must issue at a discount, they will receive less cash upfront while still being responsible for the full $1,000 repayment at maturity. And for the YTM, for an investor like Darius Wynn, buying at this lower price locks in an 8% YTM, aligning with higher market expectations. So if the expansion project fails to generate the projected 25% efficiency increase, the company may struggle to service these payments, especially if they had to issue more debt than expected to compensate for the discount. And that is question number 3. And for the last question for tonight, how might Ardenex's projected 25% increase in production efficiency influence the company's ability to meet future coupon payments, and what financial risks remain if the expansion fails to perform as expected? So the projected 25% increase in efficiency is expected to generate higher operating income, directly supporting the company's ability to pay semi-annual coupons. And for the remaining risks of it is if the expansion does fail to perform, Ardenexes may face liquidity pressure, as we already know and we have maybe predicted, and struggle to service the debt. So these two very important and dangerous risks may lead to Ardenex's potential default. And that's it for tonight. Thank you for your attention.